So now looking at your profit and loss accounts, and these are accounts that the business has to generate so that their accounts can be audited. So if we just look at two business examples first, and we imagine that these businesses have this situation. So we've got Elwood Books earn £20,000 of revenue in cash sales and also sell £10,000 worth of sales but on credit, so they're not going to get paid till next year. They bought stock for £10,000 but only used £8,000 of that stock. And then we have this business, Hailing Island Bookshop, and they sold £25,000 worth of cash sales, no credit sales, and they bought £10,000 worth of stock and used it all up during the year. And we could think about, well, which one actually makes more profit? So we'd have to kind of sit down and do the sums. But if we do them for Elwood Books first of all, because we've just done cash flow, let's just do cash flow first. So they've got £20,000 coming in. If we're just working it out for, the dates have changed a little bit here, haven't they? It was 2014 on the other slide, and 2015. But if we imagine that over 2014 they sold, we're just looking at 2014's cash flow, by the way, they sold £20,000 worth. And then they had £10,000 going out in terms of what they bought in stock. That's £20,000 minus £10,000, which is £10,000. Now that's the cash flow, the net cash flow. But actually, when we're looking at profit, what we're looking at in terms of revenue, it doesn't matter if you've actually physically received the money in. We're looking at whether you made a sale. So it doesn't matter that this £10,000 is still owed, that's still sales. So it's £20,000 of revenue plus the £10,000. And then when we're looking at the costs, okay, yes, technically you paid £10,000, but all we're looking at is the cost of how much did it cost you to generate those particular sales. So it's called the matching concept in accounting, and it actually only cost £8,000 to generate those sales. Yes, you did spend £2,000 more of that, but that's stock that you'll sell next year. So it's £30,000 minus £8,000 is £22,000 worth of profit. So we can see there's a real difference between the cash flow or the net cash flow and your profit that you've made. So this is why in the previous presentation I said you cannot tell profit from a cash flow forecast. So in this situation they're both going to be the same because there were no credit sales and they used all of their stock. So an overview of financial accounts then. So by law, each company, so LTDs and PLCs, are required to keep accurate financial records. All businesses really should keep financial records. And these are the three main documents. The cash flow statement, and we've had a look at that. So it summarises the inflow and outflow of cash of a business. It's a bit like just your bank statement, really. Your profit and loss. So it records the money earned over a trading period of a year usually, and the costs associated with earning that money. And then the balance sheet, which is a snapshot of your business, its assets and its liabilities and what's been invested into the business. But there's a separate presentation for that one. So we're looking at a profit and loss account, and in international accounting language it's called an income statement, so it's the same thing really. The profit and loss account is like the old word, the old phrase for it. So in simple terms, profit is just basically revenue minus costs, but in the profit and loss we're going to see two types of profit. We can see gross profit and we're going to see net profit. So gross profit only takes into account direct costs of production, and net profit takes into account these indirect costs of production. So on the profit and loss, they call these direct costs the costs of sales. It just means they're directly attributable to producing the product. And then they call these indirect costs either overheads or expenses. So that's the difference between the two. And if we're looking at the difference between costs, a marketing cost is not directly attributable to maybe one product, whereas the material used in each product, that is directly attributable. So that would be a direct cost and these would be indirect costs. Now you don't need to necessarily be able to categorize them, but it's just interesting to look at which are direct and which are indirect. So if we look at our P&L account, up here at the top we've got our sales revenue and we've got our opening stock, purchases less closing stock, so cost of sales. Okay, so this is all of our direct costs. And then if you do 500 minus 180, you get 320. So that's your gross profit. And then here are all the expenses slash overheads, and they add up to 248. And if you do 320 minus 248, you should get 72. Now this is from an old legacy paper, so don't worry about this corporation stuff at the bottom. It usually just goes up to net profit when you're looking at it. But there's something weird going on up here. Don't worry either about the two columns. This is just like this right-hand column is like a summary column, but you're not accounting students, you're business studies students, so you don't necessarily always need to get them in the right column. And anyway, in the actual exam, you're writing it in an answer book. You're not writing it onto the P&L. So how do we work out this top part? How do we actually work out this cost of sales? Right, the cost of sales equation is opening stock plus purchases minus closing stock. So it's not actually called less closing stock, it's just called closing stock. They put the less there to remind people that you're going to minus that out. So you anything that was not used last year, so that, you know, when we were talking about that bookshop, the £2,000 that wasn't used, well, that's going to be their opening stock next year, plus any additional things that you had to purchase to produce your products, and then minus out any stock that you've got left, because that'll go towards being a cost for next year's accounts. So the closing stock of this year, that 70, will become, I think this was 07, so 08 opening stock. And then if you add opening stock to purchases minus closing stock, you get that 180. So that's how you work out the top of the P&L account. So if we just do an example here, can I type on this? I don't think I can. So I'll just have to do it in my head. So we've got sales revenue of 600. So if we've got opening stock of 20 plus 100 would equal 120. And then minus out 70, which I believe, does that give you 50? I think it does. It gives you 50. So our cost of sales would be 50. So 600 minus 50 would equal 550 million for that 2010 figure. So let's have a look at a kind of full P&L and filling in some of the missing figures. So I've just kind of summarised this here and taken out all the different categories of total expenses and overheads. So if we just go back to that one, you know, just summarise those there. So you've just got the total, but it's basically a simplified version of a P&L. So if we kind of fill in the missing spaces, so sales revenue, 26, I've got a calculator in front of me, I'm not doing all of this in my head. Very important to bring a calculator to the exam. $26,741 $1 million. Minus out your cost of sales, which is 16,443, gives you 10,298. Okay, and then minus out the 2,471 gives you the net profit figure, net profit before tax in this case, of 7,827. Now this is from an old legacy paper, so they've worked out corporation tax, which I think is charged in this paper at 25%. So if you times that 7,827 by 0.25, you get, oh no, I've got a slightly different figure for corporation tax. Maybe it's 30% that they're charging corporation tax at, or 20%? I don't know. This is the perils of recording live audio, I suppose. I don't know. I think it's 20% they're charging at. Anyway, good news for you. You don't need to work out these things. These are from a legacy paper. So the missing figures are going to be like working out net profit, working out total expenses and overheads, working out cost of sales, those types of things. But have a look at some past papers. There's been 2 past papers on P&L before, and have a look at those types of questions. So basically, specification objectives. Be able to calculate cost of sales, so remember that's opening stock plus purchases minus closing stock or less closing stock. Calculate gross profit, which is sales revenue minus cost of sales. Net profit, which is sales revenue minus cost of sales, or simply gross profit minus overhead / expenses.